Once we've completed the elimination entries, we can then move on to the disclosure requirements, because if we don't show anywhere in either statement of financial performance or in the statement of financial position that there are non-controlling interests who have an interest in the group, we may be overstating what the parent's interest or the group, the owners of the group have in the equity of the business and the profit of the business. So within both the balance sheet, the statement of financial position within equity, and as well in the statement of financial performance, we need to show what portion is attributable to non-controlling interests. The first way to do that, and there are two different ways you can go about doing this, and they end up giving you the same outcome, is to journalize these effects. And the journals work pretty much as so. We take, in essence, all the equity impacts and we take the non-controlling interest proportion of them. So in this case we're looking at 25%. Now the first thing that you do is you look at all the pre-acquisition equity and you take the 25% component, which is the non-controlling interest part of it, and you debit those accounts and you credit the non-controlling interest account, which is part of equity, and you credit that whatever the balance is. We then move down to changes in retained earnings. And what we're looking for here is the change in retained earnings from control date to the start of this financial year. So at control date we had 1.6 million. At the start of this financial year we had 2.12 million, which is why we needed that piece of information from earlier on. That difference is 520,000, and 25% of that is the non-controlling portion of the change in retained earnings from control date to the start of this financial year, which gives you 130. The last two things we need to worry about in this particular example is the non-controlling interest share of current profit. So we look at current profit, which was 870, multiply it by 25%, and that gives you 217,500. Now note, this 870 is the subsidiary's profit. So we're not worried about group profit, we're not worried about the parent's profit, we're just worried about the subsidiary's profit, which makes sense because the non-controlling interests have a percentage stake in the subsidiary. We then do much the same thing with the dividends paid times the $460,000 times the 25% of dividends paid gives you $115,000, which is a debit to the NCI amount and credit dividends paid.